nice Bloomberg scoop to start off the day, talking about how the FDIC is actually looking to move beyond the $250,000 insured level for all deposits at most banks. They're looking to basically enact some pretty extreme measures in the wake of both SVB and Signature Bank being taken over by FDIC, and also Silvergate voluntarily winding down operations. There's a lot of contagion in the banking sector, and they want to stem any more of that from occurring. So they're looking to ease the fears of depositors by increasing the insurance levels to what seemingly are like extreme amounts. I don't know. Wendy, your take on it? It seems like this is like a pretty wild step, but it might be necessary given that there's a lot of fear out there in the banking sector.
So this story was in regards to them using an old law from the 1930s, right, Will?
Yep.
Okay. So with that being said, I don't like all of these random laws that we have in our government. But at the same time, if this is going to help protect retail, if this is going to help protect taxpayers, because taxpayers are going to suffer the burden anyways. No matter what happens, if the banks get bailed out, taxpayers are going to pay it. If the banks don't get bailed out, taxpayers are going to get hurt anyway. So I guess I'm kind of okay with them using this law to help the underdogs. But at the same time, it makes me a little bit worrisome because we see them using some of these old laws and these old caveats to kind of destroy crypto and halt the growth in our industry. So I'm a little bit on the fence about it. But at the same time, I do want to see retail win, and I do want to see people get their money back, because if we do not make depositors whole, there could be some serious issues coming. But at the same time, I think that this is all to push through a CBDC in the future and make people scared.
I mean, it's also to make sure that the companies that are banking at some of these banks, can continue operations, right? That was the big issue with SVB, right? It wasn't just big whales who had like big giant accounts. It was like startups, right? Who had other operating expenses in these accounts. And there were something like, 90% were uninsured accounts, right? So making sure that these businesses can meet payroll should another bank fall is probably what this is all about. And I think really, when it boils down to it, it's just projecting confidence that the U.S. banking system can continue to operate as normal. Whether or not that is the case, I think is still an open question. A lot of these mid-sized banks probably have the same distressed bond book that potentially, that really arguably was the root cause of what sunk Silicon Valley Bank and I guess potentially Signature. So this could be something that I think is systemic. And I think obviously steps need to be taken to shore up confidence in the U.S. banking system. So it would make sense that Yellen would go out on a Tuesday morning and say, hey, if something goes wrong, we got your back, right? And the question will be, can we do it without impacting the taxpayers? Can we do it without taxpayer funding? And then that goes to sort of like these scenarios where we've seen, Warren Buffett reportedly in talks with the Biden administration to lend a hand should some of these distressed banks need help. So it's going to be interesting to see what comes after this and whether or not, again, this projection of confidence at least does have that intended effect of keeping people a little bit less frazzled than they were last week. I don't know, Will, what are you thinking?
Yeah, some historical thoughts here, because that's my angle, I suppose. So the FDIC actually came about during the 1930s because of all the banking issues, right? Like that's why it was enacted in the first place. And it's been updated a few times, including during the last Great Recession in 2008, where it's bumped from $100,000 up to $250,000. So there's a long history of this insurance program being used by the government during emergencies in order to backstop the financial system, mostly being banks. They really want to protect depositors here, which I think does have like some democratic values to it, which is like a very good thing. That being said, there's a lot of political issues here that a lot of people get worried about when you start thinking about like who they're going to protect and why they're going to protect them. We saw that really with the SVB thing, right? Where like tech startups were heavily involved with SVB. SVB was being bailed out. And immediately we saw tweets from the likes of Elizabeth Warren and others saying like, why are we bailing these people out when we can't help out ordinary Americans who are dealing with 6% plus inflation rates? So it's just wild to see, and it's expected to be seen, the fact that money is going to be politicized, and when you have to make acute decisions with insurance programs protecting depositors, you're going to see it politicized more and more. And last thing, to Wendy's point, the Stabilization Act is more or less like the power they're using here, or possibly could use here, in order to backstop depositors. Because right now, per Congress, they don't have the ability to do anything past the $250K limit, but they might be able to use this exchange stabilization fund that was developed in the 30s in order to go around Congress. I think if they do that, you're going to see more frustration between Congress and the Biden administration. There's already been a lot of people in Congress, especially on the Republican side, who are not happy about how this whole banking crisis has been handled by the Biden administration. And if they go around Congress yet again, there could be more problems. Wendy, back to you.
But who cares if the Biden administration gets upset? Who cares if Congress gets upset? It's literally, they're supposed to work for us, hence the term public servants. They're supposed to do our jobs. And obviously, the people in charge did not do their jobs in any way, shape, or form. If they did, we wouldn't be in the position that we're in. Imagine the idea of having a bank where you charge fees to do things, and your assets are held one-to-one. You don't have to worry about FDIC insurance or going through the Treasury or going through this administration or that administration, because the funds are actually there. And the bank is not doing risky investments on the side. Let's face it, every single investment is risky. And when I hear the term investment, it's like you have a 50 chance of winning and a 50% chance of losing. And I know some people disagree with me on that, and that's fine. But people think just because you invest, you're going to get money back. You're going to get a return back. And that's not the case. And we're seeing that happen with one of the most regulated industries in the United States.
Yeah, you mentioned sort of the fractional reserve banking system, which is certainly, endured a black eye in this whole thing. And I think, rightly so, Caitlin Long, who proposed a fully reserved bank in the form of Custodia Bank, but was denied a Fed application. She's been piping up and saying, hey, I have a fix here. We can do this. Like, forget about, the way fractional reserve banking works. Let's do it this way, where we just charge fees and we just keep everything in reserve, one-to-one, et cetera. But I think, at least her allegation is that because of its affiliation with crypto custody, with digital asset solutions, they've sort of been shadow banned by the Fed and weren't able to get that coveted master account. So it is interesting to see her sort of, again, championing this cause of at least one potential solution to what the banking crisis is ailing from right now. But yeah, who knows? Maybe that'll change the tide for her, and maybe it won't.